Alright, cool. I think we should be recording. But yeah, I guess today's video is going to be on Exxon Mobil. For anyone who hasn't heard of Exxon Mobil, I'll be very surprised. But as you can see here in the company description, is essentially an energy provider and chemical manufacturer, primarily, I guess, involved in the exploration and production of crude oil and natural gas. So as always, if you want the document for yourselves, just kind of go through in your own time. You can always grab the first link below, and yeah, you can grab the document from there. I won't go too much into detail on the qualitative aspects in this analysis. Primarily for this video, I just want to cover the quantitative and the quant side of things. So obviously, as of yesterday, I believe it was, yeah, the stock price was trading at $105, giving it a market cap of just under half a trillion, so 455 billion. And then I guess slightly due to the higher debt to cash position, results in a slightly higher enterprise value versus the market cap. So obviously, as I said before, Exxon is a leading global energy company operating in well over 200 countries and territories. So it obviously has global operations, and you kind of split the operations between upstream and downstream. So the upstream will primarily be the exploration production of, as I said before, oil and gas, and then the downstream is like more like processing and refining the products, because obviously when you get oil and gas from the ground and whatnot, from nature, I guess, you can't just use it there and then. For the most part, you then have to process and refine it to then use in your cars and in other products. So for the upstream side of things, they primarily have five regions, which is the United States, Guyana, Africa, Middle East, and Asia Pacific. I think the one I'd like to kind of bring everyone's attention to would be Guyana, in terms of from an investment perspective or trade perspective for Exxon. And it's kind of what differentiates it versus the other oil majors and just oil and gas production companies in general. But yeah, we can get onto that in a bit. The financial performance obviously is pretty standard. Again, we'll come on to the quant side of things a bit later, but you can kind of see there for yourselves. Product and sales, we won't go too much into, and then strategic developments. So yeah, as kind of aforementioned on Guyana, they have the Guyana expansion. And for anyone who's not too familiar with the kind of geopolitical and kind of oil and gas segment in general, essentially what happened, I guess, in 2015, I think it was discovered that a massive oil and gas reserves, primarily oil reserves on offshore, just on the Guyana coast, was discovered. And in 2024, this oil discovery essentially accounted for 74% of all new oil finds globally. So it's an absolutely incredible new discovery that was found, and it's positioned Exxon, who have a lot of licenses and rights over this region, obviously with the Guyanese government. So in terms of competitive landscape and performance, again, I won't go too much into the competitors in this video because I kind of want to focus on Exxon here. But I guess the big takeaway is the fact that Exxon has surpassed all of its peers and the other three main majors in terms of earnings, which is, again, great to see. Cool, yeah. So coming on to the abridged financial statement, the reason I've done an abridged financial statement is because I think when you start like doing more on trade analysis, especially for trading, you come to realize doing a massive and complicated DCF model, really this like the ROI on it, for instance, is just very minimal, and for a lot of time you're just wasting your time, fleshing out a massive financial model and DCF model to then come to the same or similar conclusions as the street and everyone else, especially with companies like this, which has so many eyeballs on it. But as you can see here, based on analyst estimates, the companies expect to have a slight dip this year in terms of revenue, and definitely a slight dip in earnings, and then kind of recovering that back to 2023, 2024 levels here in terms of the revenue and income. You can quite clearly see 2022 was obviously a fantastic year for all oil and gas companies, given the inflation that year, and then obviously the massive oil spike, energy actually spike in terms of, and the massive spike in energy prices, primarily due to, again, inflation and also the Ukraine-Russia conflict. So that was kind of an anomaly year. If you kind of take that out, then the company has still been growing very well over the last few years. But as always, with companies like this, they're very dependent on commodity prices. And so if you were to do a trade and not an investment in Exxon, you'd have to be well versed in commodity prices and forecast those out, and kind of either expect a massive increase or a massive decrease if you want to go short in commodity prices, to then obviously use Exxon and trade that as a vehicle based on commodity prices. Otherwise, from an investment perspective, the company's doing fantastic, very well run. The balance sheet is okay. Obviously, with any oil and gas company, they do have a greater debt to cash position, creating, obviously, as I said before, a higher enterprise value versus the market cap. But when you look at, obviously, like things like current ratio, so the current assets versus current liabilities, there's more current assets than liabilities. And then when you look at the overall equity position versus the overall liabilities position, the equities position is greater. Obviously, going on to the cash flow statement, again, I think every year except for 2024, if you like sum up the three segments of the cash flow, it's been positive. This year was slightly negative by about 7 billion, but 2022 obviously was a fantastic year where they had 2022 plus billion in cash generation. And then obviously when you focus on the levered free cash flow, it's always positive, which is great to see. Cool, yeah, but I guess the main part of this analysis that I want to focus on then is the sector analysis. And with the sector analysis, what I like to do is kind of grab the main, I guess, figures and the main factors that you'd always want to look at when analyzing a company, especially in each sector. So obviously for this sector, the primary things to look at are like revenue, the net profit, free cash flow, earnings per share, cash and debt position, and then obviously the pure analysis we'll get onto here. Having a quick overview and look here, as you can see, I've kind of highlighted the positives and negatives by color coding them. But what we can see here is these are the oil majors, and then these are like the primary, like the big significant independent oil and gas companies, sorry. So I think one thing obvious to see from a valuation perspective is that the enterprise value over sales, which is simply again the enterprise value divided by the sales, for all the oil majors is below the sector average, and then for all the independents is usually above the sector average. And the reason for this primarily is just because of takeover threat or assumptions, whichever way you want to look at it. Obviously, if you're an independent, it may be a threat. Obviously, if you're a oil major, it's a potential opportunity. But essentially, yeah, because of takeovers where you have a lot of consolidation in this sector, especially during times when there's about to be an oil boom or energy boom. A lot of these major companies tend to buy up the smaller ones, and because of that, the market obviously knows that, and so investors usually give a greater valuation to the more independent oil companies. So this is pretty much standard, so as you'd expect. What I found quite interesting actually, however, from this analysis of the sector was revenue growth. So especially for the next coming year, all the oil majors are expecting to see a dip in revenue, which again, if you've been keeping up with the oil prices and just geopolitics in general, that's kind of in line with the expectations, given oil prices have come down quite a bit. And then obviously we're hopefully going to be expecting the Russia-Ukraine conflict to end. Inflation hopefully is going to be coming down. So it's kind of in line with expectations. Although a lot of the independents are forecasting revenue growth, especially Diamondback, which is very significant revenue growth from 10 billion to 14 billion. I don't know if maybe a potential acquisition is influencing this. I definitely know for ConocoPhillips, they just had an acquisition last year, I believe. So that could also be playing a part for them, for these entities. But yeah, just quite, I guess, interesting to see from that perspective. Although earnings growth, again, is every company in the sector is forecasting negative earnings growth, as for the aforementioned reasons, geopolitical reasons, and obviously the commodity prices coming down for 2025. And then I guess the next part of the analysis for the sector, and I guess Exxon as well, is that these three columns here, and these are obviously very specific to the oil and gas industry. So I think before I go into these, I think I need to explain what a barrel oil equivalent is. So BOE, and essentially what a barrel oil equivalent is, as you can see here, broken down, and the calculations, is essentially the total proven oil reserves. Is essentially the total proven reserves of a company. So from their crude oil, natural gas, any other types of energy they may produce. And so it's all those proven reserves, aka essentially what's in the ground. So for instance, with Exxon Mobil, we know that they have the license to the offshore in Guyana, and so everything that's, I guess, being calculated and proven by, obviously these fantastic scientists and whatnot, and engineers, sorry, they can see what's in the ground and their expected reserves that they expect to, I guess, extract from the offshore or from the ground if it's onshore. And so all of those reserves that have been proven, so aka they've kind of seen through different technological devices, all of those reserves, I personally then multiply that by the average price, so the average realized price in the previous year. So during 2024, these were the average realized prices for each of these segments, and then you kind of get a total barrel of oil equivalent value. So here you can see it's 870 billion, and so that's essentially what these two figures are here. So all these figures I've kind of gone off in different analysis for every other company and got the oil and gas reserves in dollar value, and then that is essentially being divided by the enterprise value of the company, which, as I've already mentioned, is just the market cap minus cash plus the debt. And so from this analysis, you can kind of see, first and foremost, Exxon have by far the greatest oil and gas reserve in dollar value, which then backs the fact up that it has by far the largest market cap in the segment as well, or in the sector, sorry, which again is primarily driven to this Guyanese offshore find that they essentially stumbled upon and managed to get, which was fantastic for them. Exxon have a quite high premium valuation versus the sector. I guess one comment I can make on this also is for the oil majors, we typically tend to see on average around 40 to 50%, and then for the independents, they usually have around 30%. And so as you can see here, Chevron, Shell, and Exxon all have decent premium valuations, especially the two US oil and gas majors in Chevron and Exxon, whereas the EU or the European oil and gas majors have much lower premium valuations. And I think this is kind of justified, right? So you can kind of see it here in the forward EV to sales valuation multiples as well, both under one and under one for Shell as well. And I believe the reason for this much lower premium valuation is just because they've been operationally they've been very poor. So you can kind of see it here in the net profit figures, especially for BP and Shell, like pretty much breaking even though like other companies like Exxon and Chevron are making billions in net profit. Total Energy also did, to be fair to them, have fantastic net profit last year, but I think if you kind of dig more into them, obviously I don't want to spend too long on the other companies, but if you kind of dig into Total Energy, you'll see that again they have quite a lot of operational issues, and justifiably so, I guess. They also have a lower premium valuation. The EV to BOE dollar amount is a much more easier figure to calculate, and all it essentially is, as you can see here, these are the rough estimates, but it's just the proven reserves divided, it's the enterprise value divided by the proven reserves. So then it essentially then replicates or shows how much the industry or investors are valuing each barrel of oil the company produces. So for Exxon, for instance, is $28, and then obviously for like a smaller company like EOG, is $12. And obviously these figures here is what makes, I guess, potential acquisition so attractive for the larger oil majors, because they can essentially buy barrels of oil hypothetically for much cheaper prices here if they were just to acquire these companies. So I guess a comment on the overarching summary of the sector analysis from an Exxon Mobil perspective is that, yeah, sure, the company's trading at a premium, but I think justifiably so. They're performing fantastically. They have by far the greatest oil and gas reserves, and it's pretty much standard and in line with expectations in terms of the analysis and what I would expect. So yeah, cool. So just before we go on to the quant and the final part here in terms of valuing the company, just wanted to bring attention to the other qualitative aspects. So you have a strength and weakness, opportunity, threat, so SWOT analysis, which is kind of typical in management accounting and I guess management analysis. So you can kind of pause the screen here, look at it, or again grab the document below in the description. You have Wall Street insights. So here is just basically kind of what Wall Street are thinking. So kind of gives you more information again on a qualitative perspective on the business operations and how the company's performing, and then some key analyst takeaways here. Won't go too much into detail. And then obviously, if you were to trade it, you obviously want to see the technical analysis perspective. So from a price momentum perspective, it's actually kind of a strong sell. And then in terms of a TA, specifically in terms of looking at resistance and support levels, it's kind of in like no man's land in the middle. However, and then sorry, before actually I do that, you can then see the latest earnings call report here in terms of summarizing everything, the bullish highlights, bearish highlights, and then some misses and highlights, Q&A highlights, sorry. But yeah, then one thing I wanted to mention then was the support. So the support is currently seems to be around just under $100, around $98, which perfectly actually aligns then with the quant analysis here in terms of the price target that I've come to. Quite simple in terms of the valuations here. So the first valuation, which is the ones in this row here, is essentially just the company's EPS multiplied by the prior year price to earnings ratio. So prior year, the price to earnings ratio at the end of the year was around 14. So valuing the projected EPS, which we're obviously grabbing from the abridged financial statement, it gives a rough price target for FY25 of $97, and then for 2026 of $116. Obviously, this is market expectations, so what I denote here. So what I usually like to do is two things. So I like to value a company based on its earnings and sales, obviously assuming the company's profitable, which Exxon is. So here are the earnings valuations, and then here are the valuations of the company based on its sales. And then I like to break that down into further. Basically, I like to have a valuation based on what the market is perceiving. And then I also like to value the company based on a reasonable valuation multiple and then kind of break it down much more here and the full analysis. But essentially, the reasonable valuation is based on multiple things, but primarily historical valuation that the company, historical valuation multiples the company has had in the past, plus the sector and kind of valuations versus its peers, and kind of conjoining both those two, I guess, information factors, I then come to what I call reasonable valuation multiples. So you can kind of, again, grab a document or pause the video and read it for yourself here. But essentially, from my analysis of the sector and of the historical multiple valuations, valuation multiples, I come to around, I think, a reasonable P/E ratio of 12.5. This is also factoring in actually the cycles. So what essentially happens is when the oil and gas industry is in a kind of distress cycle, the P/E ratio tends to inflate and enlargen. And then when the oil and gas sector has a fantastic year, like we saw in 2022, the P/E ratio comes down significantly. And so because of that, I think the cycle we're in at the moment is, again, we've just had a slightly distressed cycle here in 2024, but I do see it improving a little bit, essentially, but kind of staying similar. And so then that also plays a part in the 12.5 P ratio. You could argue the fact that the fact that oil is around $60 at the moment, that you could ideally maybe give it a 15 P ratio, but then again, that's for you guys to go in and into the document yourself and kind of play around with the figures. This is more just an overview and my thoughts. So that gives a price target of $87, and then based on the sales multiple, so the prior sales multiple was 1.39. If you were to value the company based on that, you get a price target of $106, which is pretty much in line with the current price as of today. And then again, if you were to give a reasonable and I would say quite a prudent actually sales multiple of 1, because again, it's not really hovered at 1 for the last few years, but again, it's been quite prudent and safe, I guess. Gives a price target of around $76. And then, as always with all my models, if you watch any of my other videos, I also then do I also grab essentially AI price target models. So all that summarized gives it a price target of actually $126 per share, and then the average of that then gives me 98, which, to be fair, quite interestingly does align with the technical analysis in terms of the support. so that's always good to see. And then I personally like always having a 20% upside or 20%, I guess, safety net. And so then assigning that, you get a price target valuation of around $82. So for me personally, I think Exxon is a fantastic company, and I think versus its sectors in terms of the management, the operations, proven reserves, it's for me the premium company, and justifiably so in terms of the market cap of the sector. I think Chevron is a good second place, so primarily based on the two US oil majors. However, I think again because of this, it is valued at quite a premium. Also, given the current macro conditions, where a lot of investment companies and funds are transitioning from high growth tech stocks to more defensive and safe stocks like Exxon and the oil and gas sector, we're not seeing the price come down as much. However, if we do see oil come down quite a bit, then it might create opportunities to get into Exxon as a long-term position. Or if you, for instance, are quite good at forecasting commodity prices and you do foresee that the oil price is going back to maybe 70, 80, then I think Exxon would be a fantastic vehicle to trade that through. But yeah, I think that's everything I wanted to get across in this video. I just realised it went on for much longer than I expected, even cutting out the qualitative aspects. But yeah, I think I'll leave it there.